Sailing through uncertainty, seeking Canadian banks' credit cusp. That was the theme of an industry event that was held in Toronto by Bloomberg Intelligence and Morningstar DBS, looking at challenges and opportunities for Canadian banks in the current climate. We're joined by Bloomberg Intelligence analyst Paul Gulberg. It's great to see you. When the conference was called CUSP, does that mean the point at which credit losses stop getting worse and start getting better? There's an improvement in credit quality?
Well, I think it answers half of the question. So I think it's the peak. And the peak is now expected somewhere in late 24, maybe in the first half of 25.
In losses.
In terms of provisions for losses. Yeah. But we don't see them coming down for quite a bit. So even if we look at the consensus numbers for provisions for next year, literally every one of the 6 banks have roughly the same amount as they have for this year. So there's a long way for them to start turning around. It's not going to be like we did have to happen during the pandemic when they shut up and then quickly the banks started releasing them. It's going to be a while. They're going to have to keep those provisions high. Is it
mostly on the commercial side, the real estate side in particular? Is that the main problem?
Well, it's not necessarily the main problem. Obviously, what we've heard from Bank of Montreal that surprised quite a few people during the second quarter earnings. So it was on the commercial side and it was in the U.S. commercial side. So a lot of the U.S. commercial side is getting hit for the Canadian banks up here first. CRE is a biggest chunk, but BMO also talked about transportation and services, some other points there. And if you think about the CRE, it's usually a very long tail process.
Commercial real estate.
Commercial real estate. So it can take years, and it could be a good quarter versus a bad quarter, wherever the building is going to go down.
Is BMO having more problems with provisions in the States than RBC, for example?
I don't think they're necessarily having more problems. They might have taken a little longer to start taking those provisions. Maybe they were hoping for the rates to turn a little bit faster and resolve some of the problems. Also, the BMO's commercial book is usually sitting within a commercial bank. RBC's commercial provisions are sitting within the capital markets business for the most part. So it's a little bit of a different book of business, but they're both very well diversified. So even though BMO kind of guided to higher provisions for the second half, it doesn't seem to be sort of a systemic problem.
TD has this money laundering investigation, but apart from that, it's in a big apart from, I know, how have their provisions been going?
Their provisions kind of in line with other banks, so they're fairly reasonable. They're mostly, obviously, not a commercial, but mostly retail bank, so those provisions kind of easier to model and they kind of don't take lumpy chunks, but rather they go through the process gradually.
What about the capital adequacy of the Canadian banks? Do they have plenty of headroom right now?
I do think they have a reasonable amount of headroom. So the CET1 ratios that cover the capital levels they require is over 13% for most of them. The requirement is about 11.5%, so there's quite a bit of a buffer. The domestic stability buffer that some people were concerned might have to be increased from 3.5 to 4.5 was affirmed yesterday at 3.5, so that resolves some of the problem. I think a little bit of a weight on some of the Canadian banks that have operations in the U.S. So U.S. is waiting for the final outcome of the Basel Endgame, so the rules that govern capital levels in the U.S. And that might be some of the drag that might require a little bit more capital once those announced.
Poor old TD, I see the ratings agencies, at least some of them have them on negative watch, just because the imponderable here. People just don't know which way this investigation is going to go.
Correct. So with our policy litigation analysts, we put a number of yardsticks. So people sometimes compare it to the USB that has a $600 million fine, which is roughly what they already reserved. Right, so they have a lot of different other agencies investigating them. Then people start comparing it to HSBC, kind of a similar issue, which was a $2 billion provision. And then we've heard some other analysts calling for $4 billion, which is a little bit out there, probably high. But whether they're going to have to take 1 or 2 or even 4, they can easily digest it within their earnings and within their capital power. It's going to limit their buyback and things like that, spending on returning capital to the investors. But the biggest issue for them is kind of what happened to Wells Fargo, where you get restrictions on asset caps or restrictions on kind of capital levels, and that can very seriously impede their growth. But it's an unlikely scenario given what's going on.
Oh, you think that the regulators won't be as hard on TD as they were on Wells Fargo?
Yeah, I think it's correct. I think it's a different issue. So it's an AML issue, money laundering, rather than deceiving your customers issue that Wells Fargo faced. So it's kind of a different scenario for them.